In this Money Talk video, I'm going to discuss certificates of deposit or CDs and describe what they are and how to best use them. And we're starting right now. Hey guys, welcome to another video from the Keystone Financial Academy. My name is Elliot, and if you're new to this channel, I invite you to join our community by subscribing and turning on notifications so you don't miss any of the upcoming videos. Certificate of deposits or CDs are commonly used savings instruments, and they're offered by nearly every bank and credit union. CDs are not exactly bank accounts, but rather just sums of money that you give to a bank for a predetermined length of time in exchange for interest. There's a catch, however, with CDs, and that is you cannot withdraw your money, in other words cash in the CD, prior to the maturity date without incurring some penalties. By tying up your money in such a way, the bank is free to invest it without incurring the risk of having to give back your money on demand. You as the depositor, however, lose the ability to invest that money elsewhere. Therefore, a higher interest rate is paid out to you for that opportunity loss. In other words, you're forfeiting liquidity for a higher return. While interest paid out on CDs is tied to the prevailing prime rate, which is pretty low right now, they are still better than money market accounts and certainly a lot better than regular bank savings accounts. And just like regular savings accounts and money market accounts, CDs are also protected by the FDIC up to $250,000 per deposit. Let's go over some of the details of CDs to determine if they're right for you. Certificate of deposits are technically referred to as bank promissory notes, which means the bank promises to pay, and are also a form of a time deposit, meaning there are time restrictions to withdrawing your funds. They are also fixed income securities in the sense that the interest rate is locked in when opening the CD and generally doesn't change throughout the term of the deposit. CDs often have a minimum cash requirement to open. This amount varies quite a bit, but ranges roughly from $250 all the way up to $1,000 as a minimum. A CD under $100,000 is called a small CD, and anything above $100,000 is referred to as a jumbo CD. CDs also have varied maturity dates, which is just the length of time which your money will be tied up in. This also varies quite a bit, but 3-month, 6-month, 1-year, 3-year, and 5-year terms are quite typical. As you may imagine, the interest rate varies with the term length, with their higher rates generally offered on the longer term CDs. As mentioned earlier, CDs come with early withdrawal penalties. You typically forfeit all or some of the interest earned before the withdrawal. So it's important to pick a term that you can live with. So why put money into CDs? Well, they are a great place to park cash for a fixed amount of time and have both FDIC protection for the principal and usually an inflation-beating rate of return. They are a bit of a step up from money market accounts in terms of the interest rate paid, as long as you don't mind not having access to your money. If that is an issue, you always have the option of purchasing CDs with shorter maturity dates, such as 3 months or 6 months, but of course you will collect a lower interest rate for those shorter dates. Generally, if you need access to your money in less than 6 months, a money market account is a better idea. And if you want to learn about money market accounts, there's a link to that Money Talk video in the description below. So aside from not having access to your money, are there any other reasons not to put cash into CDs? Well, just like with money market accounts, CDs are not a good idea if you're seeking growth investing for the long term. While CDs will usually beat inflation and give you a modest and safe return, they're not a good place to find a significant income stream due to the low interest rates. Certificates of deposit come in a few other flavors aside from the traditional CD that was described thus far. There's a no penalty CD, which can in fact be redeemed before maturity but at a cost of a lower initial interest rate. Then there's the raise your rate CD, which give you the option of switching from a lower interest rate to a higher interest rate if interest rates rise fast enough, but again at a cost of a much lower initial interest rate. Finally, there's a zero coupon CD, which is a lot like a zero coupon bond in the sense that the CDs are purchased at a discount to their face value and make no interest payment, but then you redeem the CD at full value for a profit. Last but not least, it's worth mentioning the certificate of deposit ladder. This is simply a technique where you purchase numerous CDs at predetermined predetermined intervals, but of similar maturity dates. They then mature at regular intervals, giving you more liquidity to access cash, or the ability to reinvest your money at a higher interest rate if the prevailing interest rates in the market are rising. They resemble steps in the ladder, hence the name. What would that look like in practice? To make the math simple, let's say you have $12,000 to invest. You can then purchase a 3-year, $2,000 CD every 6 months, taking 3 years to invest all of the $12,000. Just as you're done investing, the first $2,000 CD matures. You can then either reinvest it at a higher interest rate or use the cash if you need it. You never have the full amount tied up in one lump sum, and the staggered maturity dates give you a lot of flexibility in how to use the money and plenty of chances to reinvest in something else while still getting the benefit and protection of a CD in the first place. So how do you open a CD? Well, you can head to your neighborhood bank or credit union, but more likely these days you can do it all online. You'll have to provide some basic personal information, then the bank will ask you to select the term, 3 months, 6 months, 1 year, 3 year, etc., and of course the amount that you're looking to deposit. You then make a cash deposit if it's a physical bank, or link your accounts and transfer money if it's an online bank, and that's pretty much it. When the term is up, you will see the interest rate you earned added to your principal balance, and then you can either withdraw the money or reinvest it. So what sort of rates are CDs paying out these days? As of February 2021, you're looking at about 0.65% APY to just over 1% APY, depending on the term length, with the higher rates for 5 or 6 year CD terms. The best rates are with the online banks such as TIAA, Discover, Ally, and others. Compare carefully, taking notes of the APY, the term lengths, and the minimum deposits required before committing your money. Alright, that was a quick Money Talk primer on the basics of certificates of deposit. If you enjoyed this video and found it useful, please do consider subscribing, and I'll see you guys again soon.